Hi, I'm Bob French. Today, I want to talk about buffer assets. Now, we've got a whole article on this on our website, retirementresearcher.com, so check that out for more details. The link is in the description below. But for now, let's jump right into it. So let's start with the basics. What are buffer assets? Well, they're pretty much what they sound like. They're assets that serve as a buffer between your spending and the volatility of your investment portfolio. These could be anything from the cash value of a whole life insurance policy, lines of credit from a reverse mortgage, or just plain bonds. They help control when you need to sell volatile assets from your portfolio to fund your spending, which helps you manage your sequence of returns risk. You can kind of think of it as a very small scale time segmentation strategy. Now, in simple terms, having buffer assets can help protect you from having to sell investments at a loss in a down market. When the markets aren't behaving, you can spend out of your buffer assets and give the market some time to recover. And then when the markets do come back, you can potentially refill your buffer to protect against future down markets. Now, you might think that sounds perfect, right? Well, nothing's ever perfect. Well, they can be a great tool. It's important to remember that there's always a trade-off. Since the whole point of buffer assets is that they don't have the same volatility as the risky assets in your portfolio, they also don't have the same high expected returns as those riskier assets. Since that money isn't facing the same level of risk, it means it also won't have the same level of potential return. But simply, holding buffer assets means that you're holding back some of that money, which could potentially reduce the upside from your investment portfolio. You're protecting yourself from sequence risk because of the flexibility in when you spend your risky assets, but potentially giving up some growth. Let's face it, most of our retirement plans rely on some level of growth from our investment portfolios. So the question is, just like most of the time, how do you want to make this trade-off? Now, how you answer will really come down to the amount of buffer assets that you want to hold. This could very well be zero. You're perfectly comfortable spending out of your risky assets, all the way to having a full-blown time segmentation strategy. Again, just like always, this is where I tell you to take the RISA to really get at how you approach retirement income. If you haven't had a chance to take it before, there's a link in the description below that will let you take it for free. But let's get back to thinking about how many buffer assets you want to be carrying. That's where things get interesting, and it's worth looking at some history. If we look back from 1926 through 2023, the S&P 500 index has gone down in a little more than a quarter of the years. And the down years are sprinkled reasonably consistently through time. If we look at rolling 30 and 40-year retirements, they both average out to roughly 1 in every 4 years was a down year or a negative year for the S&P 500. Now, it's important to note that a diversified portfolio, one that includes all of the different areas of the market, including bonds, is probably going to be a bit better than this. But just looking at the S&P 500 index makes things a lot simpler and provides a decent negative baseline to work off of here. There's a lot more to say here in terms of looking at the length and severity of downturns and how long they took to recover. But if you're interested in that, take a look at the article on Retirement Researcher again. The link is in the description below. But to sum up all of the numbers for substantial drops of 10% or more from their beginning peak, basically the bad parts of the market, it took the S&P 500 index, on average, about 3 years to recover. Though if you exclude the Great Depression, that average dropped all the way down to 26 months. And in fact, nearly 2/3 of those big downturns had completely recovered by the end of 2 years. So based on this historical data, the question is, how much should you hold back as a buffer against the markets? As I mentioned before, this will ultimately come back to your personal risk preferences and financial goals. You may decide you don't want any buffer assets, or you just want to hold a small amount to smooth out any bumps in the first couple of years after retirement, when your sequencer returns risk is highest. And then maybe not bother refilling those assets once you've used them up. Others are going to want a reasonably large amount that can even out whatever the market throws at you, within reason, though it's important to keep the risk and return trade-off in mind. At a certain point, you'll probably want to just build a rolling bond ladder, and then you're just using a bucketing approach. But remember, these are just averages, and past performance really is not indicative of future results. At the end of the day, the size of your buffer should be something that you're comfortable with, balancing the benefits of reduced sequencer returns risk against the cost of potentially reduced growth. Remember, buffer assets are a great tool, but they're not for everyone. Weigh the trade-offs and make the decision that best suits your retirement income plan. And the best way to really start sorting these types of questions out is to start with taking the RISA. The RISA will help you understand your personal retirement income style and what that means not only for how you structure your investment portfolio, but the whole of your retirement income plan. And even better, you can take the RISA for free with Retirement Researcher. Just go to retirementresearcher.com/free RISA, all one word, and sign up to take it. The test only takes about 15 to 20 minutes to complete and will give you the information that you need to really customize your retirement plan. If this was helpful, be sure to like this video and subscribe to our channel so you can see what we're up to. If you have any questions on this or any other questions you'd like me to address, just drop them in the comments below. You can also check us out on the web at retirementresearcher.com and make sure to sign up for our weekly newsletter to keep up to date with everything that we're doing.